What is the forex market? How is the quoted price different from the stock market? Foreign exchange is the most traded instrument in the world. Nobody needs to buy stocks, but we must somehow deal with the forex world. Every time a barrel of oil is bought, everybody has to buy the dollars except for Americans. Chinese must change their yuan into dollars to buy oil, since oil is priced in US dollars. Every time we travel to France, we must convert our money to euro. It's not hard to understand why it's traded the most. Cross-border capital flows for investment takes up another massive quantity of foreign exchange transactions. First of all, the stock market is a centralized market. It's made up of a stock exchange, where stockbrokers and traders can buy and sell stocks, bonds, and other securities. Whereas the forex market is a global decentralized market for the trading of currencies. It's the largest, most liquid market in the world, with an average daily trading volume exceeding $5 trillion. All the world's combined stock markets don't even come close to this. But what does it mean to us? The international currency market is a special kind of the world financial market. Traders' purpose on the forex market is to make profit, as the result of currencies' movement from buy and sell. The exchange rates of all currencies being in the market turnover are constantly changing under the action of the supply and demand alteration. Current exchange rates of foreign currencies fluctuate towards its highs and lows. Using these fluctuations in accordance with a known principle, buy low, sell high, we obtain gains. Forex is different, compared to all other sectors of the world financial system, because of its heightened sensibility to a large and continuously changing number of factors. It's accessible to all individual and corporation traders. High trade turnover creates an ensured liquidity of traded currencies, since the round-the-clock business hours let us trade after normal hours, or during national holidays in our country. Just as on any other market, the forex market is built in with an exclusively high potential profitability. It is possible to be successful after a certain training, including getting familiar with the structure, the principles of currencies price formation, the factors affecting exchange rates movements, and trading risks levels. All sources of the information is necessary to account for all these factors, techniques of the analysis and prediction of the market movements, as well as with the trading tools and rules. An important role in the process of the preparation for trading forex is to trade using a demo account, with some virtual money, which allows us to try out different theoretical knowledge, gain some of the trade experience, and not being subjected to a material damage. Since there is no central dominant authority that controls trading, there is no central forex exchange, and there is no single clearinghouse. Business in the forex market is simply done on a handshake. If we trade stocks, all of the transactions are settled through a central exchange, like New York Stock Exchange, makes sure that our trades are cleared. The exchange's main function is to guarantee that different groups of buyers and sellers can come together and make trades without having to worry about whether the person on the other side is good for the money. But this is not how it works in forex. Forex is known as the over-the-counter market. We deal directly with our market maker. So there is no third party guaranteeing the transaction. Everybody works with each other on a credit basis. That means everybody must trust everybody else to make the settlement. Settlement is usually 2 business days forward, but due to modern technology, all players in the market know their true exposure in real time. When we trade currencies, we can do it through different places such as banks, brokers, or exchange stores, as long as we and other party agree on the exchange rate. Those firms are known as dealers, who are actively involved in large quantities of foreign exchange trading. Since the stock market structure consists of having all orders routed to one central exchange with no other competing market, the quoted prices of the various securities listed on the exchange represent the only price that is available to investors seeking to buy or sell the specific asset. Decentralization makes the forex market unique, because unlike exchange-based stock or bond markets, there is no central order book, so there is no best bid or ask price. In fact, there is no one location where currencies are traded, so it is possible for traders to find competing rates for a given currency from various dealers from around the world. Just like in any market, where prices for identical products may differ from one merchant's stall to the next, so too, in forex prices for one currency may vary, depending on which dealer's quote we receive. This process may seem baffling, but the large group of participants actually makes the forex market the most efficient and liquid in the world. In reality, competition among brokers is so fierce that the bid-ask difference in the most active currency pairs are often only 1 point wide, equivalent to only 0.01% of the contract amount.